What's going on, guys? This is Lior, and welcome back to my channel. So I'm a real estate investor, and I do videos about all aspects of real estate investing, regardless of your age. So in this video, what I was going to talk to you guys about was actually taking out a HELOC, or a home equity line of credit, on an investment property. Now, you probably heard you can do these HELOCs on primary residential homes, right? So let's say you've got a single family or a condo that you own. Most people know that you can take these home equity lines of credit against their primary residence, but you can also take them against investment properties. And honestly, this is one of my favorite parts about real estate, is that you can leverage past transactions, right? In the sense that you can take equity you've built up in different buildings that you've owned and use that to lever up and continue to expand your business, expand your portfolio, and so on. Strategically, of course. So right now, the reason why I decided to make this video is because I'm actually right in the process of closing on a home equity line of credit on the first investment property, or actually the first property in general, that I bought almost 4 years ago at this point. And what's crazy is I bought that property now just about 4 years ago. I used an FHA loan to buy a 3-family. I only put $25,000 into that deal. And today I've got a ton of equity sitting in that property, and I'm finally able to really leverage that equity. And when I close on that home, on this HELOC, I'll be able to actually tap into that equity and use that as cash to continue to expand and grow my business and grow my portfolio. Can't really get that anywhere else. It's really one of the beauties of investing in real estate. So in this video, I wanted to give you a few details about what the terms of the home equity line of credit look like, and then as well as a couple of details, as well as a few specific things you need to be on the lookout for if you're ever going to go down this path and actually try to take out a HELOC by yourself. So in terms of the details of how a home equity line of credit works, there's really no difference between investment property versus a primary residential home equity line. Basically, the terms that I can share with you guys. I got 10 years of interest-only payments for my line, right? So that means once I actually draw cash from that line, so let's say I've got a $50,000 line, I only get charged interest only on the amount of cash that I use whenever I draw, right? So let's say as soon as I close, I take out $10,000, I'm going to be charged interest only on that $10,000. And if I decide maybe in 2 years to take out another $20,000, then I'll be charged on a grand total of $30,000. But what's cool is, again, I'm not actually paying a full amortizing loan, right, on that home equity line of credit. It's only interest-only payments, which makes my debt service on that loan way, way easier, way, way cheaper, which is really nice. Now, after that 10-year mark, that loan will convert to a fully amortizing loan where I'll have a designated amount of time to pay it back. But, 10 years is a long time. I don't know if I'm really planning on having this line open for that long, maybe a couple of years. We'll see. But again, it's nice because I'll have those low payments throughout, where I'm only paying interest. I'm not paying down any of the principal. So let's talk about a couple of details you should keep in mind if you're going to go down this path. Number one, finding an actual lender to do a home equity line of credit on investment property is definitely way trickier than doing it on your primary residence. On your primary residence, almost every single bank will certainly take a look at that kind of loan. I mean, that's really bread and butter for most banks. But to do a home equity line of credit on investment property is definitely a lot trickier. And you gotta be able to screen a lot of different lenders, a lot of different banks, to really see which lenders offer you those options. Not only that, but you're typically also going to get a smaller LTV. And what I mean by that on an investment property, and what I mean by that is on a home equity line of credit for a primary residence, some lenders will go up to 75%, all the way up to 80, potentially even 80% loan to value of the house, right? So let's say you've got $1 million house, you only owe $600,000. In theory, an 80% LTV, you could take a line of credit for $200,000, because it would take you $600,000 existing loan, $200,000 home equity line of credit puts you at $800,000, which is 80% of your $1 million value. So that's with primary residences. But on the investment side, what I found when I was talking to lenders, even of the ones that were even willing to consider doing home equity lines of credits on investment property, typically their loan of values were a lot lower than your primary residence, right? So most lenders were between 65 to 70%. I was, after much digging, able to find someone who would be willing to go up to 75%, but it's rare, right? It's definitely much different beast than doing a HELOC on your primary residence. This is especially true when you're asking a lender to come in as a second position, right? So basically, if you're not going to do a refinance with an additional home equity line of credit and combine it under one lender, right? If you're going to keep your existing loan with lender A, and then lender B comes in, to do that home equity line credit, again, it just adds to the complication, especially when it's an investment property. It adds to the complication of really finding a good lender to be able to take that loan. Number two, you got to make sure when you're thinking about taking a home equity line of credit, and this is regardless of whether it's your primary residence or your investment property, but certainly very important with the investment property, is you got to make sure the underlying cash flow is supported, right? Because my property right now, for example, has very strong cash flow. So that's why I'm not worried about taking an additional loan and creating additional monthly debt associated with that property. But if you're, for example, if you're thinking about doing an investment property where maybe you're only cash flowing, say, $100, or basically breaking even, and you're going to take this additional debt, obviously you just got to be very cognizant of the fact that, hey, I'm taking on additional debt that might cause me to actually have to pay money every single month rather than maybe break even or cash flow or whatever it is. So the point is, make sure you're comfortable with the debt service. Make sure you're not overstretching yourself, because even though leverage in real estate is fantastic and it's really great to use to continue to expand and grow, you want to do so strategically, because leverage, as good as it is, can easily bite you in the butt. Finally, I want to talk quickly about a home equity line of credit versus a cash out refinance. The other option, so basically if you're not familiar with a cash out refinance, the other option you can do is do a full refinance of your loan, and then instead of creating a line of credit, you essentially cash that amount out as cash. Well, why would you want to do that? Well, a couple of negatives to it. First of all, typically on a cash out refinance, especially on an investment property, your interest rate is typically going to get jacked up quite a bit. So you're going to pay your entire loan balance. So let's use that example again. $1 million house, you have $600,000 current mortgage, and you want to take out a $200,000 line. If you do a cash out refinance for $200,000, you're going to have a brand new balance of $800,000, very likely at a pretty high interest rate. So your entire loan is going to get jacked up, and your monthly debt service is going to go up quite a bit. Whereas with a home equity line, I don't touch my first mortgage, right? Whatever my terms of my first mortgage, hopefully they were good, remain the same. Whereas on that second part, on the $200,000, again, it's not like you're paying full interest and principal on it at a higher rate. You're only doing interest only, for at least for the first 10 years, right? So make sure you really do the math and understand, hey, if I do a cash out refinance, yes, I'll get that cash, but is my new monthly debt service that I'm going to experience worth it? And finally, the other thing that's kind of cool about a home equity line of credit is, if you're going to do a cash out, yes, having cash is nice and you can go spend it and boom. But with a home equity line of credit, it's a revolving line. It's basically a line of credit, right? You can take out, say, $10,000 or $20,000. Maybe you pay some of it back. Then maybe in 2 years you go take another $20,000. Maybe pay a little bit of it back. It's basically an open line of credit that you can use, and you don't necessarily have to go through the refinance process every single time, right? Because with the refinance process, it's a grueling process, right? If you ever refinance the property, you got to go through all the paperwork. You got to go through the appraisal. You got to go through the closing costs associated with a refinance. It's a decent amount of work, and it's a decent amount of money. Whereas with a home equity line of credit, again, once you have that line of credit open, it's open, boom. You can use it, pay a little bit of it back, et cetera, and avoid having to go through the logistics of refinance. So those were some of the considerations I wanted to share with you guys, and one of the reasons why I decided to go with my home equity line of credit. Hopefully I don't jinx myself in this video. I should be closing on this loan in a few weeks, but that is the rationale of why I decided to choose this path. So if you guys have any questions, any comments, shoot them below and I will answer them.